Hello, hello. This is Abel Pacheco, your host for the Five Talents podcast, How to Build Wealth Like the 1%. So we're interviewing some of the best experts that we can possibly find to figure out how to create wealth and how to preserve as much of it as possible. And so we are super lucky today to have Mr. Garrett Griffin, because he is one of those experts that advises, helps people direct their, ultimately their assets, the tax strategy, the implications that everything happens, involved in creating wealth and trying to preserve it. And man, we were super excited to have him. So Garrett, let me introduce you for a moment, and then I'll turn it over, because if you don't know Garrett, you need to get into his world. He's the principal of Legacy Tax Strategies, LLC, and Legacy Legal, LLC. He has his JD, which is the Juris Doctorate, and his LLM, which is the Masters of Law in Taxation. He's got 20 years of experience doing this. He's been specializing in helping clients defer capital gains, their taxes on the sales of really highly appreciated assets, which is our goal. We want to buy assets, we want them to increase over time, and then we want to save as much as we can from the tax man. So he's been doing that for years and years and years. And also, we're going to talk to him a little bit about this expertise, or this area of expertise that he has that few do, with deferred sales trust. So anyways, I'm excited, if you can't tell. Garrett, let me turn it over to you for a moment, man. In your own words, just tell us a little bit more about yourself.
Sure. Well, first, Abel, I appreciate the time today, and really hope that the information that we can cover and share is going to be beneficial to the audience. And so you're right. It's, it happens quickly, but, I've got 20 years of practice, and, for purposes of our discussion today, I'd call myself a wealth strategies attorney. And ultimately, we're going to talk a little bit about some of the specific strategies, and I'm a deferred sales trust trustee. But, really my training has been, in what I would call an integrated approach of, estate planning, asset protection planning, business planning, and really tax planning. And I really think that, the intersection of all of those things are going to go right towards your audience today. If we're talking about, hey, how do you build wealth and look like the 1%, there's some common things that happen, and some of the planning strategies. And, just because it's something that the Rockefellers used doesn't mean it's not applicable to people who still have wealth, but maybe you're not Rockefeller wealth. But, one of the things that really has driven me and my team and my firms over the last few years is that, we're here to serve clients. And our belief is that private capital remaining in the hands of the family is going to serve the family and society as a whole much, much better than if we turn over 30, 40, 50% of that to the government. And so that drives a lot of, I think our value system, and, who we work with, and, and the techniques that we try to employ. And so, that's over a 20-year career, you finally kind of start to hone in a little bit on, what's driving us, and, we want to do certain things for clients, and ultimately that is really what's driving us, and from a motivation standpoint.
Yeah, love it, man. Thank you so much. I'm excited because there's a few things that our audience is going to love today. So if you're a high net worth individual, HNWI, you have $1 million to $5 million worth of net worth, and you're trying to figure out how to make 5 turn into 10, 20, 30, and get that ultra high net worth status that's $30 million plus, or if you're a family office, that you, like you said, there's having some wealth, trying to create it, and then acting like, pulling a play like the Rockefellers, right? Billions of dollars, kind of trying to figure out how to do that. Well, you have to make the same plays as they're doing to actually get there. Otherwise, it just doesn't happen. So just learning about it. And, if you're just a high earner at this point, you're a high W-2 earner, 250K plus, and you're making that money, you may not have, the $1 to $2, $3 million yet, but you need to start acting as if, so that you can get there. And I think the things that Garrett's going to talk about today are right on point. So if I can, I'm going to break a few things you said down first for our audience, because
Thanks.
I heard a wealth strategist attorney. Man, let's just unpack that for a minute. What is that? What does that mean for us?
I think, historically, when I got into the legal realm and started with a firm, they called you the estate planning attorney, or maybe you were the business planning attorney. And then obviously I was in the middle of, the first 2 or 3 years of practice when I went back to school to get my master's in tax law. And I think what was really interesting is when I really started to focus on the estate planning side of the practice, years 7, 8, 9, it really became apparent that it's really truly an intersection of multi-disciplines. And, it all of a sudden started to become apparent that there was some commonalities in, one, the clients that I like to work with, because they all started to have the same problems. They all started to look alike. And, that usually meant that they were starting to accumulate wealth. And a lot of that wealth, I'll call it, they were in complex assets. That means, beyond just, hey, I got some money in a brokerage account or I got some money in an IRA. There's certainly complexities to those and the ability to plan for those types of assets. But what I found was clients had real estate holdings. They had interests in business. They had interests in, maybe IRAs and 401ks, and those usually had pretty large sums in them. And so those assets became complex. And now even fast forward a little bit more, and we've got more complexity with cryptocurrencies and NFTs and those type of things. Yeah. And so all of a sudden, the clients that I enjoyed working with started to, there was developing a commonality amongst them. And what was they had a lot of messy stuff. There was a lot of complexity, which meant, there was a lot of planning and opportunity for us and the clients to have, tax saving strategies, estate tax strategies, business strategies, and all those types of things. And so that opportunity was there, but it gave some flavor to practicing law. It wasn't a cookie cutter approach. You couldn't go in and say, well, I got this kind of trust and everybody's going to fit into that nicely. No, you really had to think, and sometimes think outside the box, and look at, well, what are some of the cutting edge strategies? And you try to find the really sharp guys that do it throughout the U.S. and you say, okay, what are they doing? And how can I implement that with my clientele? And so, it's really been that over the last decade, where, I think I've been able to really kind of focus and hone my practice in with that particular type of client, which, again, it drives me personally in our mission. It makes the work more enjoyable, but then we stumble across these new strategies, because it's you don't know what you don't know sometimes.
Yeah.
So things get introduced to you and you go, well, yeah, I never thought of it that way. Or how did I not know about that? And one of the strategies we talked about today, it was, I went 17, years practicing in the space and didn't understand and know that it truly existed. And, you come across that. And when you do, it's great because you're like, oh, well, here's a solution, or, that may work for some clients. Yeah. I love it. That's, if I heard a couple of words right, I heard your top clients or some of those clients were having the same problems as they were accumulating wealth. They had very complex assets, and they were trying to figure out how to do that. And there's an intersection of your investment and an intersection of maybe this law part of it that goes together, because not only am I trying to make sure that my wealth is earning more, is providing a good return, but the other term that Garrett, mentioned, if you didn't write it down, asset protection. As you accumulate more, the last thing you want to do is lose it, not because the investment was bad, but because you didn't have some of this legal stuff shored up. You're making, hundreds and thousands, millions of dollars of return, and you let it fall out of a leaky bucket because you didn't have, a document in place that you could have spent a few $1,000s to put together, right? So those are those things that I think I heard. That's a summary. You're exactly right, because as when you look at I'll call it kind of the old and outdated term of estate planning, you're just like, oh, what happens to me when I die with all my stuff? And all of a sudden, well, one, that's not incredibly attractive because all you think about is death.
Who cares when I die, right?
Right. And while, yes, it's absolutely important, but it becomes part of the cycle of the planning with clients. And so you talked about the wealth creation. So I say, yeah, there's a wealth creation and accumulation phase. And sometimes that continues on, but then you've got the protection phase where I need to make sure that it's protected while I'm alive.
Yeah.
And then there's even then the final component, which is more of the historical estate planning. That's the preservation. Okay, now I'm gone and it's going to go to my spouse or my children or my grandchildren. How do I make sure that is what I've created, that it's preserved for at least another generation or two or more? And so you kind of have those phases. And I really think where the wealth strategies comes in is you're really part of all those phases now, not just the back end, what happens when you die. It's much more integrated across the board. And some of that's been my own personal experience with those clients, with those commonalities, but also all the variation and changes and fluctuations in tax laws and those type of things have led to that in addition. So
that's another thing too, right? There's this complexity of this ever-changing law, tax law, rules, IRS changes. It's never going to be, oh yeah, I used to do this 10 years ago. Man, that's completely different now.
Moving target.
These things, if you've got some means to yourself right now, let me pause you and say, hey, there's a lot of things that we're talking about and Garrett's going to illuminate that may be a little difficult to grasp, number one, or maybe you've never heard before, number two, or maybe you know about them, you know all the buzzwords, but you've never been able to take action. You gotta choose one direction, focus down, and just take a small step of action towards, reaching out, getting one thing in place before you move to the next. Don't worry about 10 different strategies. Just take an action on the best next step and go from there. What would you agree,
I would
disagree,
say,
Garrett? What do you think, man?
Yeah, there's really in my mind potentially two answers, and you could kind of choose one. Getting some, especially if you've got a family and you're starting that accumulation, having some level of some basic estate planning documents, because the unfortunate thing is with 20 years of experience in estate planning, you see the unfortunate happen. And especially with COVID, everybody got a real heavy dose of mortality and what that means. And so, you reflect on that and you think, man, we don't know what the next day holds. And if I weren't here, I don't want a mess left for those that are behind me. And so having those basic, revocable living trust, power of attorney documents in place, to me, that's really step one. And probably right close behind that is as you start to accumulate and think about those things, it's developing some type of what I call a tax engineering plan.
I love it. I'm excited about this. So I have a feeling I know where you're going, because I literally, for ourselves and our family, I had a bunch of stuff. We're accumulating assets. If you don't know us, if this is the first time you're listening, we're in about 1,500 doors of commercial multifamily assets. This is the vehicle we've chosen from our family to say, let's put our time, effort, energy, let's put all our eggs in the basket. In this basket right here, and we're going to watch the basket. I might have a little diversification over multiple deals, but that's the basket we're choosing. We're putting it all in. And the first step was, well, shoot, what happens if I pass? And my wife's like, where's all the paperwork? Where's all this stuff? Right. So we put together a living trust, and then we started funding and putting everything in there. And it also, I learned through this process of, like, something were to happen, this is really the only way to avoid a probate, a lawyer, a judge making a decision. It's like, no, I don't want them making a decision. We wanted to control that. Right. But the second part that Garrett's about to jump into, which I think I heard it, correct? Let me turn it over, man. What were you going to say? What's this next part?
It's really that tax engineering component, and and everything's always, I agree. You phase those things in. What's my hot button? And sometimes the hot button is something else. And especially when we deal with business owners, those that have closely held family-owned businesses, a lot of times it's, well, what's your hot button? Even though I may have some preconceived notions of where I want to drive them, you want to serve the client, and so it's like, well, what is it that's keeping you up at night, and can we address that? But really that tax engineering plan, and that really can take on a lot of different shapes, and that could be, well, just I'm looking at my income taxes. How do I lower my income taxes? That could be a strategy. And is it my ordinary income? Is it my capital gain income? How can I leverage taxable assets into tax-free wealth? There's a component that I'm looking at there. And then, then you've also got, as a separate taxing mechanism that the government employs is, okay, well, if you've accumulated enough and now you've got yourself into potentially a taxable estate, now I need to do some estate and gift tax planning as well to minimize taxes. And so, you're looking at that tax engineering from multiple facets, and and not everyone's going to be applicable to you at any given point in time. But if you're constantly doing that review, working with the professionals to say, okay, well, I'm invested in these things, that's going to result in this type of income tax. How do I have ways of structuring that to minimize that? Is there a way to defer? Is there a way to eliminate? And so, there's all kinds of techniques, both from the income tax side all the way to the estate and gift tax side that, otherwise, if you, like I said, you don't know what you don't know, you just kind of go blindly into things, and, you're not going to be as efficient in accumulating as you'd like to be.
Yeah, I love it. Thanks for giving the insight, right? It's tax engineering. When I was younger, I thought taxes was a prescribed amount that you had to pay the IRS no matter what. And later, as I learn, I go, oh, yes, that prescribed amount is accurate if you're a W-2 employee only and you don't employ some of these strategies that the wealthy are deploying because you have the means to do it. You can work with an expert, hire someone else's years and years and years of experience, and leverage their insight to help you make the right move. And then you can literally engineer your taxes. Figure it out. Do I want to pay a lot this year or do I not? Do I want to push some stuff over next year or not? And those plays are what the wealthy 1% are doing today. They're literally determining how much taxes am I going to pay this year and do I want to or not? Because it may be more beneficial to save my assets, to make sure that our hard-earned money stays our hard-earned money, right? And not, give it away to the government. And so this is a good mindset, Garrett. I think, man, I'm excited to hear you keep talking. Let me pause for a minute and try to hold my excitement. So you mentioned that, these are some of those plays, tax engineering, right? Yep. So as we kind of move a little bit further on, if I can ask you a question about your clients, right? The clientele that see you, what is your typical client range? Maybe describe the different tranches you have. Here's my majority of base. Here's what they're doing. Here's my next level up, and maybe what these top earning or the wealthiest clients are doing. Maybe just illuminate a little bit of that so we get a picture of it. Yeah,
historically, I would say the typical client that you get more of, just because it's almost bell curve-esque, is that you've got a lot of clients that are probably worth $1, $2, $3 million that have been W-2 earners for the majority of their lifetime. They've built up a retirement account. They've got a modest home, some other savings, and they've got quite a bit then in these retirement vehicles. And I would say, from a number standpoint, those are the most clients that I've dealt with over my time.
I'm gonna pause you right here too. Yeah. So I heard $1 to $3 million, W-2 earners, made a good living professionally. They've stored up, they've saved like crazy. What are their typical age group that you see them in there?
Yeah, they're all, approaching retirement or after retirement, and most of those clients have strictly been estate planning. The complexity of their assets is really not there. They don't have business assets that they're trying to exit from. They don't have a lot of real estate holdings, and so they're really
if I can pause you again, man. I'm sorry. I'm interrupting Garrett. I'm going to let him. All right. I'm going to let him talk. I promise, audience. But just even in this part, there's a lot of knowledge, because without complexity of asset, without a lot of interest in businesses, without a lot of interest in real estate, it's going to take you longer to get there in your retirement age to jump from $1 to $3 million. And that's the majority of Garrett's clients. And I would say the majority of those clients are probably pretty happy. They led a great life. They're, oh man, they did all the right things.
Right. Absolutely.
We're not even talking about the people that didn't, but if that's the lifestyle that you want, that's okay. But that's it. This next category, man, illuminate this a little bit for us.
Yeah. So the next one is, the assets certainly start to become a little bit more complex. And I would say, somebody has ventured out and gotten into usually real estate. That might be direct holdings. We've got a rental or two, and it may be single family, it may be multifamily, but they've started to accumulate a little bit there. They may have some, limited partnership interests or some, in a syndicate or something like that. So it's usually kind of in that area where they've started to venture out with, a more variety in their portfolio. And so, certainly now all of a sudden you're looking at, okay, well now asset protection becomes an issue. Business planning becomes an issue, where either you yourself are creating an LLC or you're becoming a partner in a general partnership or a limited partnership. And now all of a sudden you've got business documents and all those things. So all of a sudden that complexity jumps up, as does the tax planning. And so you start to see that. And then, there's probably a couple layers above that. And that's where you've got, it's a combination typically. Somebody has got a closely held family-owned business that has started to really produce, and it's produced enough additional income net after tax that they've gone, and now they've also got real estate holdings in various methods. And so, the complexity then builds again, and then it really is, the complexity is the same, except you just have different levels of wealth of how much has been accumulated. So, I would say the majority of my clients are probably between 15 and 20 million. That's a really good chunk. It's a great group to work with. And then you've got, and then there's a handful of clients that I've got that are kind of that 20 million plus, and they just, just got more, it's worth more. And,
I'll pause you before you go here, because this is good insight, right? This is really good insight. For the people that are trying to figure out, well, if you're on a path to create one or two or three, Garrett almost laid out a really good roadmap, right? And then if you're trying to figure out how to get from 3 to 15, by nature is kind of what I'm hearing, Garrett, correct me if I'm wrong, but I'm trying to figure out the complex investments. I am a part of an LLC. I am a partner in this. I do have interest in, I heard syndicate, I heard real estate, which, isn't news to me, but I kind of set it up to you to talk about it, because that's what a lot of our investors do. Like, people ask me all the time, like, how are y'all doing that? We're raising millions and millions of dollars. We buy commercial properties, $10 to $20 million plus. In a 30 to 60 day window, we're raising like $5 to $7 million. People pouring in their money back and forth, because those are the individuals that have figured out, I have to go to a little bit more complex investment to try to figure out how to diversify outside of my IRA, my stock market, and that plan. And they're taking those extra risks. They're leveraging an expert like Garrett's team to say, like, is this the right play? And the experts are saying, yes, a good majority of our investors that are in the $10 to $15 million range, this is what they're doing. And it reinforces, it builds confidence to say, this is the right direction. When other people are telling you, no, don't do that, and that person doesn't have $1 million and you're trying to figure out how to get to the 4 or 5, you got to talk to the experts. You got to talk to the pros. Got to talk to somebody like Garrett and his team, because they advise people how to do this like all the time. So anyways, man, I'm sorry. I get excited.
No, you're exactly right. And it's, each level you go up, it's not necessarily one particular, set of strategies that it becomes important, is that each one of them exponentially becomes more important. The asset protection is more important. The tax engineering is more important. The estate planning component is more important. And so each one of them, this just really just ratchet up another level as you go in. And the more that you look to say, well, how do I get myself from this level to that next level? A lot of times it's going to be some of that tax engineering. How if I can save more and, in taxes, then I've got more to use. And ultimately that becomes, a big chunk of it. And, how do I take taxable assets into a tax-free environment? How do I defer taxes so that I can, use my money more so than, giving it to the government?
Yeah. I think that's our next discussion, right? Well, hold on. There's 3 things. There's the top of the top. I do want to know, what the heck are they doing different that we need to be doing? So that's one. Let's talk about deferred sales trust, which are deferring taxes.
Yep.
So that'll be the second one. I'm going to write those notes down to make sure we hit them.
Yep.
But before we get there, right, it's I want everyone to kind of get it and realize. I was talking to a buddy of mine. He's raised $150 million. In other words, he's helped place about $150 million of investor capital in investments, and he's doing pretty well. Yep. He said that, one of the years that just kind of blew his mind was he didn't view himself as a, ultra high net worth or a family office type of, guy. It was just more like, we're making money, we're doing good, cool. But what he told me was the light bulb that went off is he made a move towards the end of the year that cost him $50,000 in taxes. He lost it. He missed. It was so much going on, right, that you missed this move, and it cost you 50 G's in taxes. And he goes, man, had I just hired somebody, $50,000 payroll type of individual or an expert, and given my money to somebody else that can advise me, I could have probably either paid them less or at least probably 100% avoided the 50K in losses had I just had an expert that was helping me advise me with my own stuff. So you may not be in this $50,000 kind of loss position, but I mean, 5K, 10K, 40K, 30, all of these numbers add up, which is why I always say, man, I don't know all these things that Garrett's talking about, but what I do is I hire experts around me to help me make the right plays. And this is where Garrett's, company and teams come in.
Yeah. And I think you said it's all relevant to, we talked about the Rockefellers earlier, just because of the level of wealth that they've created doesn't mean the same strategies aren't applicable to the rest of us that are trying to get there. And you look at that and, you said, okay, well, maybe it's not a $50,000 deal, but what if it's a $5,000 deal? But what if it's a repeatable $5,000 that you're missing? And all of a sudden, 10 years and now it is 50, and what could you have done with that 50? Over that period of time? And that's, and ultimately that's, when you look at, I think the upper, which was one of your points.
What's differentiating them?
What are they doing? I would say, from a particular strategy, they use life insurance very well. And it's a layering of strategies. It's not, we've got one thing, one silver magic bullet that's doing it all, although life insurance is a pretty good one. It's a layering of the various strategies. And again, it's all an intersection. So it's not, hey, we've deployed one thing. No, they've deployed 15 things.
Wow.
And all of them working together, then you've got a cohesive plan and you're like, okay, well, now it's not just I can take one step. I put all those things together and I just took 15 steps.
Mm-hmm.
And so those things, the sum, of the various parts is greater than if you just added them all up individually. And so when you have those strategies that are layered on top of one another, you got some exponential ability to progress.
That's great, man. Thank you so much for illuminating that. I think it's very helpful for our audience. Whatever place you're at in your financial journey, the beginning, middle, or end, you can absolutely learn a lot from this conversation. I would say if you didn't, rewind it, take some notes, and get it on, take some action. Right? Okay. So we're talking about deferring taxes. There's things that we kind of know and hear about a lot, capital gains taxes and stuff like that. But also we heard about this deferred sales trust, and I'm gonna turn it over to you. You're an expert. I don't want to steer you down the wrong path. Tell us what that means and what kind of strategies we can be employing right now.
Absolutely. From a high level, what this particular strategy allows us to do is really gives us some control over the tax liability. And we're talking about capital gains tax. And so this strategy applies to the sale really of any capital asset. So that could be a professional practice. It could be any type of business, closely held, family owned, commercial real estate, investment properties, syndicate interests, partnership interests, high-end primary residences, major stock positions, cryptocurrency, NFTs, artwork and collectibles. So anything where you have some type of capital gains transaction. So it doesn't necessarily have to be a highly appreciated asset, although we run into that a lot, but it could be situations where you've got an adjusted basis because of depreciation on that particular asset and the fair market value. But essentially you've got a capital gains transaction. And what this strategy does is it allows you to control when you want to pay that tax. So it is a deferral transaction and technique. It is not an elimination technique.
All right.
We're
kicking the can down the road, right?
It does not make it disappear, but it does defer. So when we work with a lot of clients, or we work with a lot of professional advisors, and they're working with the clients, and we run into this an awful lot. And we have a couple scenarios. And one is the client doesn't want to sell the asset because they know there's going to be a tax. Or the other one that we come across probably just as frequently, and that is the sale is going to happen pretty soon. And all of a sudden they've had a discussion with the CPA, and the CPA said, this is the check that you're going to write, or the proceeds that you're not going to get because you've got to turn around and pay them to the government. And then it's like, whoa, well, I don't want to do that. Or what do we do now that we're already kind of down that road, the ball is rolling type of thing. And so, for those clients that are sitting on the fence, they don't want to sell an asset, we say, well, we're going to unlock that trapped wealth because they feel trapped because of the capital gains. Well, I don't want to remove this position or exit this holding because of the capital gains tax. And then the other ones, like I said, it's a little bit more like triage. It's, hey, this is going to hurt, and we're already, too far down. What can we do to alleviate some of the pain here? And so effectively what we're doing is we're using the installment sale portion of the code. So that's code section 453. And if you think about a normal seller finance transaction where you're selling an asset to a buyer and the buyer is going to pay you over time, this looks a little bit like that, except the risks in a normal seller finance transaction is that you're relying on this buyer whom you may or may not know to pay you back. And if they don't pay you back, you end up with the property that you sold, which you may not want, especially if it's a business or something that's going to require a lot of extra work. And so in this situation, we're using section 453 of the code, and we're going to effectuate a sale of the asset to what we call the deferred sales trust. So the trust is a completely separate standalone vehicle that is created by the trustee. So I'm one of those trustees that we had talked about. There's, I think, 17 of us, maybe 18 of us in the US. And so the trustee creates this trust, but it's got its own specific business purpose, which is to handle this transaction. And there's
trustee.
There's the potential that this trust could potentially have some income over time. But what's going to happen is the trust is going to purchase the asset from the seller. And the seller is going to take back a promissory note. And that promissory note is going to be structured as an installment sale. That independence of the trust becomes paramount. You'll see these transactions fail, and it's because, well, I used my brother-in-law. I used the CFO of my company. And so that independence of these and why there are, training and limited numbers of the trustees is that independence and some specific knowledge around the transaction. And so what happens is likely the seller has already identified a buyer, and they come to us in all different phases of a transaction. Some have not even put the property on the market yet. Others are like, hey, I got a closing, that's imminent. And so the trust is created, essentially buys the asset from the client in exchange for a promissory note. And shortly thereafter, the trust then consummates the sale with the third-party buyer. And so the trust then ultimately ends up with the proceeds that the buyer has then paid. And now buyer, they've got their asset. They go down the road.
Sure.
They're out of the picture. And so now the trust has assets inside of it. Initially, it's just liquid proceeds that came from the buyer. And that now is the seller's collateral. So the relationship went from I own this asset and here's this independent trust to now the trust is the debtor and I, the client that was the seller, I'm now the creditor. I'm like the bank.
Yeah.
And my collateral, it's the assets inside of the trust. And because I'm the creditor, I have the ability to use the investment manager that I want to manage those assets.
Yeah.
They're going to develop a portfolio allocation that is consistent with my risk tolerance profile, as well as ultimately what terms we negotiated on the promissory note. And all those things kind of work in conjunction with one another.
Yep.
And so that now is their collateral. Now we'll have clients and when we first go through these discussions, they think, oh, well, the trust is my trust. This is not your typical estate.
An independent trust.
Yeah, it's not your typical estate planning trust. It's a business trust.
Yep.
And so the parties are just slightly different, but the client is not a party in the trust. They are the creditor to the trust, but they get to approve, because they're a secured creditor, they get to approve the portfolio allocation. And so you've got that as kind of the relationship, is that the trustees don't manage the money themselves. They're going to look to the advice of a financial advisor. Usually it's going to be chosen by the note holder. And so that's really the relationship. And so when, prior to the transaction closing, the client is going to set really the terms of the promissory note with the trustee. And, every client situation is a little bit different, but if you want kind of the biggest bang for your buck, you typically what we'll have is we'll have a 10-year interest only promissory note, which means that when I initially have that sale, it's not a tax recognized event. I don't recognize any tax liability. So this is where we get our deferral, because what I get is I get a promise to pay.
Yeah.
Now, like I said, a lot of times we have 10-year interest only promissory notes. And so the trust will start at some point paying interest to the client. That is ordinary income to the client. It's paid by the trust to them.
Yes.
But we still are deferring our capital gains tax because I've not received a principal payment. So until I do receive a principal payment, I've deferred the capital gains tax. And so if you look at that, Abel, and you think, well, how do we get from this level to the next level?
Yeah.
What we've essentially done is when you sell that asset to the trust, you've created the taxable event. But because of the promissory note, you don't have to recognize that tax yet. Or more importantly, you have to pay the liability yet. But you owe the tax. At that point in time, you owe the tax to the government, but they've said, well, we're not going to collect it yet because you're doing it on the installment sale treatment. So when you receive some principal, that's when you'll pay the tax. Well, if you go at least 10 years without taking any principal, you've deferred for a 10-year period. So, trying to use some simple math, if you had a $3 million transaction that was all taxable, because we usually end up with clients that have very low basis in something. Let's say it's a $3 million purchase price. So the whole transaction is taxable. Well, you're going to pay probably 30% between capital gains and state taxes and potentially the Medicare surtax and all
$900,000 for those that aren't catching that math. There's like $900K.
Right, $900K, or we'll use $1 million for simple math. So what we basically did is, if I don't have to pay that $1 million till at the earliest 10 years from now, I just got a tax-free loan from the government. They said, you owe the $1 million, but we're not going to collect it until you get paid down the road. So what's great about this, again, it's a deferral strategy, but you're getting to use the money that you owe the government. You get to use it tax-free. They're not, and interest-free. They're not charging you any interest on that over that period of time. And so until you get to that maturity on the note, you've deferred. Now, what's great about the note structure is when you get close to maturity, let's say, again, you did a 10-year note, prior to the maturity, you could say, hey, this is a great deal. I don't necessarily need that capital for other things. Let's renew this thing. Let's renew the promissory note. We'll get another 10 years.
Up again, right?
And so all of a sudden you're getting that use of that money that you'd otherwise pay in tax over a 10, 20, 30-year period. The great thing is if you pass away as the note holder, that does not trigger the payment. So if you held it, your spouse could be a beneficiary of that note. Your children could be a beneficiary of that note. So in theory, indefinitely, we could continue to defer this tax. Now, again, it still is owed. And if somebody says, hey, kids, let's say, they inherit this note and they say, hey, that was great. Maybe I don't want to go 10 years. Maybe I'll do 5 and then I'll let it mature and then I'll pay the tax. Okay, that's great. But we have gotten to use that money.
Choice. Yes, the choice. And then we have control
30
over.
years. Yeah, absolutely. So a lot of power there. Again, client has that asset then is the promissory note. That's an asset that they can, transfer to a spouse, to children, et cetera. And so a lot of power there, and their death in and of itself does not trigger maturity on the loan. And so pretty powerful from that standpoint. What I think is maybe another step beyond that in terms of where the leverage can come in is the ability for the client to potentially do a joint venture with the trust.
Okay.
So client exits an asset, and let's say we've got some money sitting in the trust that we'll call it, is being managed. The financial advisor is managing those assets. They've done a portfolio allocation. 2, 3, 4 years goes down the road, and the client says, hey, this opportunity came up. I can go into this other project, but I don't have all the money that I need. And the trust says, well, we can use up to 80% of what we're holding. And we'll create an LLC with you, and the trust will own 20% as a preferred member, and you'll be the 80% managing member. And the trust will take that money and make a capital contribution to the LLC. Now let's go buy the project. And so we've got some flexibility there that it doesn't all have to be and kept in managed money all the time. We like to keep that 80-20 ratio because obviously there's liquidity needs for expenses and those type of things. But we have that ability to enter into joint ventures with the note holders to leverage those funds a little bit better.
Wow, Garrett, man, if that one was a little hard to follow, if you've never gone into the world, this area of becoming the bank, of seller finance, of promissory notes, of leveraging, leverage in general. This is a great one to rewind and just, Google some of these terms that Garrett's dropping, because, for a simpleton like me, one of the first things I learned about in real estate was creative financing. And it was a seller finance, which meant I could make offers on a property and ask the seller to be the bank for me. They gave me the asset. I promised to pay. A promissory note is created, and I paid them a monthly amount. And I was able to buy deals or, buy real estate without a lot of capital down. Yep. Well, this is essentially what I was asking that seller to do, which every once in a while I got lucky, but I was asking the seller to take a risk on me.
Absolutely.
Which is not what typically you want to do. But on the flip side, that seller could have said, you know what, Abel, I don't need to do that. I'm just going to create a trust with one of the 18, think about that too, how lucky we are to learn from Garrett. One of the 18 trustees in the US, 18 out of millions and millions of people, we get to interview Garrett to become that official trustee, then create the business trust, creates a promissory note. And that seller could have said, no, thank you, Abel. I don't need to take that risk. Right. But I want to defer taxes. The reason they were willing to take those risks on you, or if you're a buyer on that perspective, it's, I don't want to pay those taxes. And now you can leverage that same structure minus the risk of a buyer who may or may not pay. And so
absolutely,
that's beautiful.
Absolutely. And you look at those typical seller finance transactions, what the deferred sales trust allows you to do is get liquidity and diversification, because you don't get that on a seller finance deal, because the
liquidity, you don't get the capital back.
Otherwise, the person that bought the asset, they're still holding that asset, and that's your collateral. And that makes it, pretty difficult from that standpoint. The other side of that is, and not that it's in every transaction, but a lot of times when you have those private seller finance deals, is there's no prepayment penalty.
Yeah.
So if you think, well, I'm gonna as the seller, I'm gonna enter into a seller finance deal, and the buyer's gonna pay me over 5 years, which means that I'm gonna recognize 20% ish of my capital gains every year for the next 5 years, roughly. So I kind of have an idea in my head what that's going to look like. Except after year 2, the guy goes, hey, I got more money. I'm going to pay you off. You can't stop me. And now all of a sudden you've got a completely taxable transaction in year 2 that you thought you were going to get to spread over another 3 or 4 more years. And so in that situation, you have lost control over the tax liability in a seller finance. With the deferred sales trust, trustee's not just going to turn around and pay you off.
I love it. If you have some property today and you're thinking about doing an owner finance, trying to evade taxes, you need to reach out to Garrett. This is the way to go. Free up your liquidity, put it back to work. You understand leverage. You've created some wealth. You've done it. Now just do it again. And let me ask the simple question. I think the answer is yes, but I'm a syndicator. We put together deals. We raise capital from investors. Say someone has this property and they work with you, Deferred Sales Trust, they have their liquidity in their trusts. They can direct, 100K, 200K, whatever, up to 80% of liquidity into like a syndication deal or any other deal that they wanted to. They
absolutely could. Yeah.
There you go.
It's just done through a joint venture with them and the trust. And from a getting into and getting out of, a syndication, and this goes kind of across the board. There are some, what I'll call kind of ideal candidates. And most of the time we like to see transactions at least $1 million. Occasionally I've seen some that are a little bit lower than that, but with the way the fees are structured and the way the complexity of the deferred sales trust, if it's not $1 million transaction for you, it probably doesn't make a lot of sense. But
we kind of have that. We kind of have that line in 1031 too. It's just a lot of headache, and to get in if it's not a significant amount. But if it is, and you're like, oh, let's figure this part out.
Exactly, and and this is both a 1031 alternative, as well as
a more flexible one. I'm hearing,
as well as a 1031 rescue. So, and the trick is depending upon, which qualified intermediary you're working with. Some are a little bit easier to work with than others in terms of, on the rescue side.
Yeah.
But in terms of the alternative, if you think about it, 1031, we've got, all these different rules. I got a 45-day identification period. I got a 180-day closing period. And so what if I'm looking at this and we got, the way the market is right now, you're like, I don't know if I want to buy high and maybe I can't find another property, or I don't want to find another property, but I'm doing another 1031 just because I don't want to pay the tax. And you could say, instead, let's do a deferred sales trust, and we've deferred the tax.
Nice.
The money's all sitting in there. And now I say, I'm going to take my time and find the property that I want in the location that I want for the price that I want. So all the 1031 rules go out the window. I don't have 45-day rules. I don't have 180-day rules. I can go then with that joint venture concept. I can go back into another property whenever I want. I can use leverage on the deal.
Take your time. Choose the right asset, not get rushed into something.
That's exactly right. The other thing about it is when we do find that other property that's different than a 1031 is when we do buy back in, we've reset our basis.
Yeah. Okay.
So we can start that depreciation all over again. And so you can do that as an alternative, but you could also, again, this is where, depending upon the qualified intermediary, but let's say you're going to fail. You're in the 1031, the QI's got the money. You're not going to hit the 180 day. You're not going to be able to close for whatever reason. You're not going to be able to identify. But again, as long as the QI will agree, we could enter into a defeasance agreement, and the deferred sales trust can pick up those proceeds before the expiration of those periods, and it can then act as a rescue. So we don't blow the deferral on a 1031. So there's kind of a back way to have that save a failed 1031 exchange as well. So, a flexible tool, especially if you thought you were going to do a 1031 and for whatever reason, something happens and one of those components isn't going to be met, we've got a way to rescue that.
Oh yeah, I love it. Holy moly. If you didn't catch on here, rewind it a few times, let it sink in. This right here is one of the best strategies that I've heard in a very long time since I started getting my education in real estate and tax, corporate structures and asset protection. It's like, it is unlocking the key, I think, in the paradigms of a lot of people that thought they were very, only options were very rigid and structured. This is like, it frees it all open. So if you want to get in touch with Garrett, what's the best place, especially who do you want to reach out to you?
Sure.
And where do you want them to go?
Sure. Well, certainly anybody who has, and again, this is the panacea, a wealth strategy issue, we'd be happy to have discussions, but certainly our primary focus right now is helping clients defer capital gains taxes. So if you have a capital transaction, sale of real estate, sale of businesses, and what that could be commercial, high-end, crypto, it's really any of those capital assets. We'd love to have a discussion with you. Really, the best way to reach us is to email me directly, Garrett, GARRETT at legacytaxstrategies.com. We have a website too, that's the legacytaxstrategies.com, but probably the easiest, most direct way is just to email me, and myself and my team will respond.
Yeah, I love it. Someone that's listening, probably more than one, just found themselves $900,000, $1 million piece of advice completely for free. You need to reach out to Garrett now to figure out how to actually do that, because that just unlocked $1 million for several people. So I'm excited for you. Is there anything else, Garrett, we didn't cover today that you wanted to hit? Anything at all, man? Just
every transaction is always structured a little bit differently. So, we've generalized it a little bit where we've said, well, we sell the asset to the trust. But, every single deal that we see, clients hold those assets differently. They hold them individually. They hold them as husband and wife. They may own them as tenants in common. They may have them in an LLC. We run into situations where there's real estate in S corps, C corps. Sometimes we have clients that are selling assets out of a C corp or an S corp. Sometimes we actually have the business equity that's being sold, so the actual shares. So every one of those deals, there's some nuances in there. So ultimately, how we come to the final structure, there's always a lot of up and down, and then we say, okay, based upon all of these factors, here's how we want to basically facilitate the structure of the deferred sales trust. But the power in that deferral, I'll just say it again, you're getting an interest-free loan from the government. You ultimately, when you had that transaction with the trust, you've kind of stamped it. You've kind of stamped it. I owe that, but because of the deferral under 453, I don't have to pay it till I start recognizing and getting that principal. So if I want to take this out 10, 20 years, I'm getting to use the government's money interest-free to help me create more wealth.
When I was younger, I used to tell I worked in tech. I was a sales guy. We made good money. We made commissions, et cetera, et cetera. I used to tell the guys and the gals under me, I'm like, man, in the beginning, I was so mad at taxes because they would take out 25 or 30% or plus of my check. And that was the mindset that I had at first. And then that frustration, anger, whatever, I positioned it in my head to say, you know what? Paying taxes is actually a good thing, because the more that I pay, that means the more that I made, which was true as a W-2, sales individual, right? And so I would tell, people on my team this. And then somewhere through the process, my paradigm shifted again, which is like, no, it's bad. The IRS do not pay taxes, and this is not good, and you need to figure out how to eliminate. And I actually think you've helped me change my paradigm one more time to say, the IRS is a good guy. This is how to do this. Yep. And if you don't have that knowledge, you have a different paradigm. And sometimes those paradigms can just pause you from either taking action, making an investment, worrying about a capital gain, worrying about all these things that are like the what ifs kind of thing. Those paralyze people from taking action and moving. And what you got to do is learn how to leverage experts, leverage pros, leverage people, that can help you see through a different paradigm so that you can figure out what the wealthiest of the wealthiest are doing. And
you're absolutely right. And like I said, I feel like you have those clients that they feel trapped. Like I can't take the next step. I can't make a move because this is going to be painful to have that tax liability and to have to pay that, because it's like, well, it's a bit of a reset. I'm kind of hitting reset. I got to take this step back to then move forward again. And this helps that.
There we go. Well, Garrett, thank you so much for your time. I sincerely appreciate it. It's been a great show. For everyone, this has been another amazing episode on the 5 Talents podcast, where we talk about how to build wealth like the 1%. If you want to learn what the top earners, the top wealth creators, the capital allocators, financial advisors, individuals like Garrett, just learning from them, you need to tune in, leave us a review, leave us a rating, and then go connect with us. We're at www.5talents.capital. If you're trying to figure out the best place for you to put some of the capital, how to defer some of the taxes, and then get an interest-free loan from the IRS and figure out how to deploy it in another commercial asset that creates, man, we're happy to help you create some more passive streams of income. So again, my name is Abel Pacheco. Thanks for listening. Garrett, thank you very much, man.
Appreciate it. Thanks so much.
Bye.